Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 121, we're going to look at how you value securities for gift, estate, and generation skipping transfer tax purposes. I raise this because this is an area where I see a lot of tax preparers, especially for transfer tax returns, make errors simply by using the wrong valuation standard. So we're going to dive into what that standard is. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, when it comes to value in general, the standard for transfer tax purposes is the fair market value as of the transfer date. Now, there's a lot of permutations on how that's defined, but that's generally going to be, the price at which a willing buyer and a willing seller would exchange property, neither being under duress or coercion or anything like that, and both being at arm's length. Now, that definition aside, where you most often see this apply would be in the case of the estate tax. The transfer date would usually be the date of death, and if there's a tax liability, you might be able to use the alternate valuation date if it reduces your estate tax and your gross estate. That's 6 months after date of death. That aside, even if there's no estate tax or other transfer tax return required, the valuation standard is important and applicable here because it's going to set the basis for assets in cases where the application of a transfer tax acts to increase or decrease that basis. So this has wide application in the tax world and in the financial world as well. So even if there's no tax return, you need to know these rules, especially as it comes to securities. There are special rules that apply that we're going to look at in particular. So when it comes to filing a return, or even if you're not filing a return, setting basis, you need to use the right valuation standard for securities that are publicly traded. So, for publicly traded securities, a lot of people assume that you simply just use the closing price on the valuation date, but that's not the standard. Instead, Code Section 2031 and its Treasury regulations use a standard that's based on the average of the high and low selling prices on the valuation date. Now, if you go into a lot of securities quotes, you can see this information, but it's one of those that people tend to gloss over and they just jump to the closing price, which is incorrect. So, how does it work? We'll assume we have a security that has a high selling price of $17 per share on the valuation date and a low selling price of $13 per share on that date, and maybe a closing price of $16.50 per share. So in this case, what you do is just simply average out the high and low. You'd add the $13 low to the $17 high and divide it by 2, and that's going to give you your average, which is $15 per share. So $15 per share would be the value on this date, and not the $16.50 per share closing price. And the closing price in a lot of cases is usually going to be ignored. It could, on occasion, be used sometimes for bonds when there's no trading activity on the valuation date, but speaking of, what happens if there is no trading activity on the valuation date? If that's the case, then you have to take the average of the high and low that happened on the trading dates before and after the valuation date. Now that's easy on a weekend or holiday, especially for securities that are traded every day. So if you had somebody who died on a Saturday, you'd go to the Friday before and the Monday after, or if there was a holiday, you'd do the same thing and just take the average of the high and low on those two dates and then further average those two amounts to come up with your second average. But if there's not trading dates on that preceding Friday and the following Monday or Tuesday or whatever the case, then you have to use an inverse weighted average. And this doesn't necessarily make sense if you look at it, but we're going to assume here maybe you had a decedent who died on January 9th, a Saturday. The last trading date before death had been January 5th, and the first trading date after death is January 12th. So you use a business days approach here. You don't look at calendar days, you look at the days that there would have been actual trading potentially. So what days were the markets were open? You ignore weekends, you ignore holidays, and in this case, 2 trading days separated death and the first trading date after death. But you take that 2 days after, and you'd inversely multiply it by the average high and low selling price for the date before death. So you take that 2 days and multiply it by the average from January 5th. And likewise, we had 4 trading days that separated the first trading date before death and the date of death, so that 4 days would be inversely multiplied by the average low selling price of the trading date after death, in this case January 12th. And then you'd add those 2 products and then divide them to average them by the total number of trading days that separated the 2 trading dates that were used, in this case 6 days. And that would give you your average price per share, or your average value per share. So the knee-jerk reaction to this is often, this is ridiculous. How do I do this? And is the IRS even going to care? Well, I mean, you want to do things right, and you want to make sure there's no audit potential, and you want to make sure basis is set right as well. So the good news is there are shortcuts to this. First, oftentimes, if you have a portfolio of marketable securities, you might be able to check with a broker or custodian to see if they'll generate a gift or estate tax report, and that'll give you this information already calculated that you can just plug into the transfer tax return or use to set basis. If you don't have that, then some brokers or custodians might not provide that information, but you can access software, sometimes for a fee, that would do so for you. And then finally, if you don't have access to software, you're just simply cheap and don't want to pay for it and want to do everything yourself, you can find this information on the internet potentially. So for example, in the past, I've used Yahoo Finance extensively because it provides historical stock info. So the following is a snapshot for Apple for the week COVID hit in March 2020. So this is what it looked like that week, and as you can see, we have indicated some columns with the high and low selling price. So for example, if you had a valuation date of March 12th, you'd ignore this closing price of 62.06, and instead you'd average the high of 67.50 and the low of 62, and that would give you your average selling price for that date. I'm not going to do the math here, but that gives you a general idea. And that number would be, in the case of a death on that date, that would be the basis of that stock going forward, unless the alternate valuation date was used. So that's a general illustration that shows you how to get the info. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.